Every American investor knows the feeling. The stock market is soaring, hitting new all-time highs. It feels great, but a nagging little voice asks, is this too good to be true? Well, one of the most respected and often scary valuation tools in finance is screaming a clear, historic warning that you absolutely need to hear. This is the Shiller CAPE Ratio, and it's currently at levels only seen twice before major U.S. market collapses. Welcome to American Money, where we cut through the noise to help you build real wealth. Today, we're diving deep into the cyclically adjusted price-to-earnings ratio, or CAPE. This simple metric has successfully predicted low long-term returns following three of the biggest market peaks in U.S. history: 1929, 2000, and 2007. Right now, the CAPE ratio is sitting near historic highs, levels only surpassed by the infamous dot-com bubble peak. Are we ignoring a historic signal, or is the market truly different this time? Let's explore what the CAPE is, what it's telling us, and how you should adjust your portfolio. Before we get to the CAPE, we have to talk about the standard PE ratio. It's the price of a stock divided by its last year's earnings. The problem? Earnings can be wildly volatile. For example, in the 2009 recession, earnings collapsed faster than stock prices, briefly pushing the standard PE up to about 120, signaling overvaluation. But during that same time, the Shiller CAPE ratio fell below 15, signaling undervaluation and a great buying opportunity. The CAPE is designed to fix those false signals. So what is the Shiller CAPE ratio? It's a genius formula popularized by Nobel Laureate Robert Shiller. It takes the current price of the S&P 500 and divides it by the average of the previous 10 years of inflation-adjusted earnings. The key is that 10-year average. By smoothing out the short-term economic booms and recessions, the CAPE gives you a stable, reliable, long-term valuation check. Averaging 10 years smooths the business cycle, and adjusting for inflation ensures we are truly comparing apples to apples across decades. Historically, the long-term average CAPE for the S&P 500 is around 16 to 18. A high CAPE suggests the market is richly valued, signaling potential for lower-than-average long-term returns. A low CAPE suggests undervaluation, signaling higher long-term returns. The historical data is sobering. The ratio peaked at an all-time high of over 44 just before the dot-com bubble crash. A significant spike also preceded the 1929 crash. This is why the CAPE matters for you, the long-term investor. It is a poor tool for short-term timing. Markets can stay expensive for years, but its true value is setting realistic expectations. The strongest correlation of the CAPE ratio is with market returns over the subsequent 10 to 20 years. A high ratio means you're paying a hefty premium for future earnings, which logically translates to a slower rate of return over the long haul. The current reading is a stark reminder that the market, as a whole, is one of the most expensive it has ever been. It's the siren call of overvaluation. Now, let's be fair. Critics argue that this time might be different. They point to three things. First, low interest rates have made the stock market the only attractive game in town, potentially justifying a higher-than-average CAPE. Second, modern accounting changes can artificially inflate the ratio compared to history. And finally, the Magnificent Seven effect. A small number of hypergrowth tech stocks dominate the S&P 500. Their massive earnings pull the entire index's CAPE higher. While these arguments have merit, a reading that's more than double the historical average warrants more than a shrug. The risk of lower long-term returns remains high.
So, what should you do? The CAPE ratio tells you to prepare, not to panic. Here are 4 strategic adjustments for an expensive market. 1. Lower your expectations. Don't plan your retirement assuming the 10+% returns of the last decade will continue. A high CAPE historically suggests future real annual returns will be significantly lower. 2. Focus on quality and value. In an expensive market, avoid chasing speculative trends. Shift your focus to companies with strong balance sheets and reasonable valuations. Look beyond the most popular index components. 3. Diversify globally. When the U.S. looks expensive on the CAPE ratio, other developed and emerging markets may offer better long-term value. Consider increasing your international exposure. 4. Boost your savings rate. Since you may earn less on your investments, the most powerful tool you have is your savings rate. Save more now to make up for potentially slower growth later.
The Shiller CAPE ratio is flashing a warning sign that's hard to ignore. The odds are stacked against spectacular returns for the foreseeable future. The takeaway for you, the savvy American investor, is simple. Do not panic, but prepare. Prudence and lower expectations are a necessity. What are your thoughts on the CAPE ratio? Do you think the current high levels signal a bubble or a new normal? What are you doing to prepare your portfolio? Tell us in the comments below. If this video helped you understand this vital metric, please take a second to like the video and subscribe to American Money for more honest financial analysis. Thanks for watching, and we'll see you next time as we continue to help you build real American wealth.